Have extra cash in your budget? How about increasing your monthly mortgage payment? Maybe pay off your house in 20 years instead of 30. With the interest you would save, surely that's the best use for your money. Or is it? Stay tuned, everyone. Should you prepay your mortgage? Coming up. Hey everyone, it's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. In these videos, I share my thoughts on financial planning topics for individuals and households. If you're watching on YouTube, don't forget to hit that subscribe button. And if you are viewing this on my website, fill out that sign-up form at the top of the blog page so that we can contact you when new content becomes available. There probably isn't a month that goes by that I do not get asked the question, should I be prepaying my mortgage? Seeing the interest expense of your mortgage, paying on an accelerated schedule, and reducing that expense might seem like the obvious thing to do. Today, I'm going through a few scenarios comparing prepaying your mortgage versus other options available to you and looking at the financial consequences of each. So let's jump right in. So here we have Susan and John, two people who are each getting ready to make a home purchase. And for the purposes of this analysis, they are going to be purchasing homes that have a purchase price of $400,000. They're going to be paying closing costs of $15,000, and they are bringing $40,000 to close as their down payment. This leaves them with an amount to be financed of $375,000. Susan and John both get 30-year fixed-rate mortgages, and they're going to pay an APR of 4.25% interest on their loans. This means that Susan and John are going to have a monthly principal and interest payment of $1,845. Now, John runs some calculations and learns that over the 30-year life of his loan, he's going to pay approximately $289,119 of interest. That sounds like a lot of money to him, so he decides to pay off his loan in 20 years instead of 30, which will require him to pay an additional $477 a month, giving him a total payment of $2,322. Susan runs the same calculations and also decides to dedicate an additional $477 of her monthly cash flow to her housing costs. However, unlike John, she chooses a slightly different strategy. Instead of sending her money to her mortgage holder as additional payment on her loan, Susan opens an investment account and begins making monthly deposits into that account of that same $477. Susan sets as a goal to earn a 7.5% return on her investments, which doesn't seem terribly unreasonable, given that the time horizon for these invested dollars is presumably the same 20 years that it is going to take John to pay off his loan. Therefore, with 20 years to work with, Susan feels that she should be able to invest in a portfolio that is sufficiently aggressive to achieve this 7.5% rate. So now let's fast forward 20 years. First of all, what is the value of Susan and John's homes? I'm calculating a 6% growth rate in the value of their real estate, which is pretty close to what has been typical. Of course, this could be more or less depending upon the part of the country where you live and the strength of your area's real estate market. But that gives us a value of $1,282,854. Next, we have Susan and John's current mortgage balances. John's is easy. He paid off his loan, so he owes nothing. Susan, on the other hand, now has a mortgage balance of $180,088. However, we also need to consider the value of Susan's investment account. I'm putting that in as a line item in both Susan and John's balance sheets. However, John didn't contribute to an investment account, so his balance is simply zero. But after 20 years of $477 monthly contributions at a 7.5% return, Susan's investment account has a balance of $264,130. So if we total up these two balance sheets, we see that John's balance is just the value of his home, no other additions or liabilities. But Susan's is a bit greater than that. Susan's balance is $1,366,896. This, of course, is the net of her home's value, what she still owes on her home, plus her investment account balance. So Susan's net worth, or at least that portion of her net worth that is attributable to her home, is slightly more than $84,000 greater than John's.
This might seem a little counterintuitive. You might be thinking, how is it possible that Susan paid more in interest over those 20 years, which she did? At the end of those 20 years, I calculate that Susan will have paid approximately $247,800 in interest, while John will have only paid $182,300. Susan has paid $65,500 more than John. However, she also received an investment gain over that time in her investment account, and the investment gain was nearly $150,000, whereas John received nothing. You know, at the church that I attend, they occasionally offer a video financial class by one of the financial gurus, and I once took that class. In it, that person taught that all debt is bad debt. And in his defense, his course was really geared to people who likely have debt issues, so maybe he was just trying to keep his message simple and consistent. However, I would suggest that this message, that all debt should simply be paid off as soon as possible, is an oversimplification. With no analysis, which is to say without actually getting out a financial calculator and looking at your particular situation, one can't really say which strategy would give you the best opportunity for the greatest long-term economic benefit. One reason is this: simply saying that all debt is bad debt and should be paid off ignores the consequences and expense of doing so. Let me explain. Let's back up 20 years to when Susan and John both found themselves with the ability to pay an extra $477 a month towards their mortgages, meaning they each had $477 of free cash flow in their budget. At that point, Susan and John had a choice. They both had two expenses in front of them, two costs, one of which they were going to have to pay. John saw what I would say is the more obvious expense. It was the expense of his mortgage interest. Every month we get a mortgage statement and it tells us exactly what that cost is. However, he chose to pay a cost that is less obvious, although it's a cost that every financial planner or investment advisor is well aware of, and it has a name. It's called opportunity cost. Opportunity cost is the expense paid when one forgoes the opportunity to earn an investment return on their money. John chose to avoid additional interest expense by paying off his mortgage more quickly. However, as a result, he incurred opportunity cost. Susan, on the other hand, chose to pay more mortgage interest expense, but she avoided opportunity cost. In the end, Susan came out ahead because in this particular scenario, the opportunity cost turned out to be the greater of the two expenses, and it's the one that Susan avoided. Some of you might be thinking to yourself, since the house appreciated at 6% a year, didn't John make more money from his house as a result of having paid off his mortgage? In other words, wasn't there an investment return from those additional dollars that he paid? Well, the answer is no, there's not. And that is because of a concept that requires a little bit of an explanation.
When John and Susan purchased their homes, they established the original cost of that house. We call this cost basis. It includes both the purchase price of the home plus any additional expenses they paid, such as the closing costs. John and Susan both have a basis of $415,000. Over time, we anticipate that this piece of real estate will appreciate in value, eventually, after 20 years, reaching a value close to $1.3 million. However, if either John or Susan were to sell their houses at this point, they would not have realized a nearly $1.3 million gain. Why? Because to determine how much money they have made, which is to say their gain, we first need to subtract the amount of money that they originally paid for the house, their basis. The difference between the basis and the current value of the house represents their gain.
And here's the point. The money that John and Susan, and anyone else who gets a mortgage, borrowed from the bank to purchase their house was money that paid for the basis. And basis dollars don't change. The basis in the house was $415,000 when they purchased their homes, and barring a few special situations, it will still be $415,000 20 years later. In other words, these dollars don't grow. Every dollar that represents the appreciation or growth in the value of your home, 100%, is a dollar that you are already going to get, regardless of whether you pay down the basis dollars of your mortgage. Intuitively, you already know this. You know that the bank does not have the ability to go to John, Susan, or anyone else and say, we were fine with you paying us $375,000 of principal and interest back when your home was only worth $400,000, but now that it's worth nearly $1.3 million, we feel that we're entitled to more. No, they're not. Which points to the fact, when you purchase your house, whether you use borrowed money or not, you own that piece of real estate. If it appreciates in value, you get 100% of that appreciation. And there's no way to get any more than that. You cannot get more than 100%. The only economic advantage that you receive from paying off your mortgage early is the savings that you get from no longer having to pay interest to the bank on those dollars. Therefore, the equation is simple. Which expense should you pay to give yourself the best opportunity to increase your wealth? Either the interest expense of continuing to hold the dollars that the bank loaned you when you purchased your home, or the opportunity cost of losing an investment return on those dollars should you use them to prepay your mortgage. If you find yourself in a similar situation to this and are weighing the options of your particular strategy, I would encourage you to speak to your financial planner. There are a number of variables in this decision, some of which I did not cover in this analysis, such as what are the tax implications of each strategy, and how are you going to construct and then track your investment portfolio should that be the option you choose to implement. These are excellent questions and ones that I would encourage you to ask your hopefully certified financial planner professional. Thanks for watching, everyone. I'm Jeff Drayton. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.